Mondelez International delivered a double beat against general consensus for Q2 2026. Revenue hit $9.355 billion, which is a 4.1% increase, and adjusted EPS came in at 73 cents, beating the 68-cent estimate. But, while management raised full-year organic revenue guidance to at least plus 2%, they strangely kept EPS guidance completely unchanged at $2.97 to $3.12.
Right, and the stock reaction was just as whiplash-inducing. We saw an initial post-market pop, then a massive 4.28% rally the next day on heavy institutional volume, but then that was followed by a delayed pullback to the $62 range, mainly as macro-driven profit-taking kicked in.
Yeah, so they pull in a massive $9.3 billion. They beat the street, but they stubbornly refuse to raise their profit targets. Like, why are they leaving money on the table? So today we're breaking down where that cash is actually going and whether management is deliberately suppressing their own short-term profits.
Well, to understand that unchanged profit guidance, you really have to look at how they actually made that revenue. The headline organic revenue growth was 2.2%, but what's crucial here is that this wasn't just them jacking up prices. Real volume and mix added 0.7% to that number.
Wait, but if you adjust for package downsizing, shrinkflation basically, doesn't that underlying volume growth look even better?
It does, yeah.
Yeah.
It actually bumps up to 1.2%. So that tells you their brand equity is really holding up. Like, consumers are still putting the physical snacks in their carts. And the heavy lifting there came from emerging markets, which posted 4.4% organic growth, fueled by rapid retail expansion in India and Brazil, alongside North America, which posted 3.4%.
Right, driven by disciplined promotions. But, if emerging markets in North America are, like, the twin engines pushing the speedboat forward, Europe is totally throwing an anchor off the back. They posted a nasty 3.5% organic decline. What exactly broke down over there?
It's wild. But first, unseasonably hot weather across Europe quite literally melted chocolate demand.
Seriously. Just the weather hurt sales that much.
It really did, yeah. And when you combine that with consumer fatigue from previous pricing rounds, you get severe pushback from European retailers during contract negotiations. So chocolate volume in that region just took a massive hit.
Wow. All right. So they're moving more product overall in places like the US and India, but dealing with a mess in Europe. Which brings us back to the core mystery for you as an investor, like, why refuse to raise the EPS guidance? Where is the margin squeeze actually coming from?
Right. Well, it's showing up in their adjusted operating margins. Those contracted 120 basis points, which is a full 1.2% drop, down to 13.1%. And the two primary culprits eating those productivity gains are elevated promotion spending and hyperinflated cocoa costs.
But wait, I thought cocoa spot prices actually dropped recently. Shouldn't that be giving their gross margins some breathing room right now?
You'd think so, sure. But Mondelez is caught in this hedging trap. Think of corporate hedging, like buying insurance on commodity prices. Earlier this year, when cocoa was skyrocketing, they locked in their supply contracts at those peak prices.
Oh, right, so they're stuck paying the old prices.
Exactly. Now that the spot market has cooled off, they are still legally bound to pay those premium prices from months ago. So those hyperinflated costs are flowing through the P&L right now, creating a multi-quarter margin lag.
Okay, so the market cooled, but they're still sweating. But looking at the cash flow, they're taking this top-line revenue windfall and plowing it straight into double-digit advertising and consumer promotion. Are they deliberately suppressing short-term profits?
That is the exact strategic choice management is making, yeah. Instead of letting that extra revenue pad the bottom line to please short-term traders, they're reinvesting it to build long-term brand equity and supply chain capacity. They are choosing durable volume over a quick margin bump.
Which makes sense, but for you holding the stock, this is the central debate. Are you willing to wait out this margin squeeze while they prioritize long-term brand dominance? Because honestly, they are walking a very tight financial rope to pull this off.
They really are. They're carrying a highly leveraged balance sheet right now. Their quick ratio is sitting at just 0.37.
Right, and to put that in perspective for you, if they had to pay off all their short-term liabilities tomorrow, they only have 37 cents in liquid cash for every dollar they owe.
Yeah, that is the harsh reality of their leverage. And despite the margin squeeze we just talked about, they are still trading at a premium forward PE of 19.25x.
Which means there is virtually zero margin for error priced into this stock. If this expensive promotion-fueled volume momentum suddenly hits a wall in the second half of the year, that European anchor might just pull the whole speedboat under. Follow the show for daily earnings coverage.